We'll go to the next provision, and the next provision is family pension. Now let us understand what exactly is family pension with the help of a small illustration. On your screen, the person who you see who looks like a devil is the employer. Always, every employee feels that the bloody employer is a devil. So there's an employer and there's an employee, a very happy employee. And the employer tells the employee that, look, Mr. Employee, don't have any tension, because when you retire, I will give you pension. The employer tells the employee, no tension, when you retire, I will give you pension. Now we have to understand the effect of the pension. We have to understand the possible tax effects of the pension. From the employer's point of view, the pension which is given to the employee is a business expense. The pension given to the employee is a business expense. So whatever contribution the employer makes to the pension funds, etc., is a business expense for the employer. Now, where do you think it will be taxed in the hands of the employee? If I am the employee and I receive pension from my boss, then where will it be taxed? The answer is it will be taxed as income from salaries, because there is an employer-employee relationship. It will be taxed as income from salaries in the hands of the employee, because there's an employer-employee relationship. If you read the basis of charge, salaries, it says salary will be taxable on due or receipt basis, whichever is earlier. And what is exactly salary? It is any income which is received under a contract of employment from an employer or a former employer in connection with the employment. So whatever income is connected to the employment is always income from salaries. Now, my dear friends, I hope you have understood that for the employer, it's a business expense. For the employee, the pension is income from salaries. But now, the happy situation, let us make it a bit sad. And let us say if this employee goes into the clouds. That is, if he dies, if he kicks the bucket, if he's dead, then what happens? He's out of the picture. What will the employer say? Good, the bugger died. No. This pension will be passed on to the employee's family. Like, for example, the lady you see, this beautiful lady, she is the wife of the employee. She's the employee's wife, and now the pension which the employee would normally get will now be given to the wife or the family member of the employee. This is family pension. This is family pension. It is pension received by the family member on the death of the employee. Correct? Now, for the employer, it is still a business expense. But for the employee's wife, she is the assessee now. Where will it be taxed? What is the relation between the employer and the employee's wife? Not in the wrong sense. Don't take it in the wrong sense. I'm trying to ask you is there an employer-employee relationship? Is there an employer-employee relationship? The answer is no. And since there is no employer-employee relationship, the family pension which is received by the employee's wife on the death of the employee will be taxed as income from other sources. It will be taxed as income from other sources. So if the question says pension from X Limited, it should be treated as income from salaries. It says family pension from X Limited, then it should be treated as income from other sources. Now let us look at the taxation of family pension. There are two cases of family pension. The first case is a normal case, like the employee dies and the family members receive the family pension. This will be taxable subject to a standard deduction. The family pension will be taxable in the hands of the recipient subject to a standard deduction. The standard deduction is 1/3 of the amount received or 15,000, whichever is less. First question. Will it be taxable? Answer is yes. Normal case family pension will be taxable. The answer is yes. Under which head? Under income from other sources. We know that already. But there will be a deduction given, a standard deduction. However, there's one family pension which will be fully exempt. If the family pension is received by the family member of an armed forces employee, Now here, what do you mean by armed forces? Army, Navy, Air Force and the paramilitary forces. Army, Navy, Air Force and the paramilitary forces. If a member of the armed forces dies and his family member receives the family pension, remember the death should take place in operation of duties under prescribed circumstances, then only the family pension will be fully exempt under section 1090. For example, Major A was a major in the Indian Army. He went to fight the Kargil War, India-Pakistan Kargil War, and during the war, he got martyred. He lost his life, he gave up his life for the nation. Then when his family receives this family pension, it will be fully exempt under section 1019. I hope this is clear. Now let's take an example on how the normal family pension works. Remember, if it's the armed forces family pension, it is exempt under section 1019. But let us see how the normal family pension works. Let's take an example where the family pension received is rupees 30,000. The expenses, related expenses are 500. Understand, in this case, related expenses are to be ignored. There's no effect for it. There's a fixed standard deduction, and how to calculate the taxable amount is what we will discuss. So, let us start computing the taxable family pension under the head income from other sources. First question, ask yourself, how much is the family pension received? 30,000. Will it be taxable? Answer is yes. But before you tax it, there will be a standard deduction. How much is the standard deduction? In the chapter of income from other sources, all deduction is under section 57. So I say less deduction under section 57. Now understand, my friends, that income tax intends to give you a deduction of 1/3 of the amount received. Income tax intends to give you a deduction of 1/3 of the amount received. How much is received? 30,000. 1/3 of 30,000 comes to how much? 10,000. But there's a cap. Cap means upper limit, that at any cost, whatever be the case, the deduction should not exceed rupees 15,000. So you get a formula, 1/3 of the amount received or 15,000, whichever is lower. Which is lower? The answer is 10,000 in this case. So 10,000 will be the deduction. 30,000 received, 10,000 deduction. The taxable amount will be 20,000. Clear? Let us take another example. Now the family pension received is 60,000, expenses are 500, expenses are to be ignored, and we have to compute the taxable amount. We all know that family pension is taxable as income from other sources, so I give my heading computation of income from other sources. How much is the family pension received? In this case, it is 60,000. Deduction is under section? Correct, under section 57. The law intends to give you a deduction of 1/3 of the amount received. So how much does it come to? 1/3 of 60,000, 20,000. But at any cost, under any circumstances, they don't intend to give you a deduction of more than 15,000. So we've got a formula, 1/3 or 15,000, whichever is lower. So tell me, which is lower, 20 or 15? 15. 60 received, 15 is the deduction. 60 received, 15 is the deduction. The balance 45,000 will be taxable as income from other sources. So that is your family pension provision. I hope you have understood it properly.